A losing stock does not destroy your wealth merely because its price has fallen. The deeper danger begins when the loss changes the way you think, the way you allocate capital, and the way you measure reality. That is why one of the most expensive mistakes in investing is not buying a bad stock. It is continuing to hold it simply because selling would force you to admit that your original decision was wrong. Whatever brought you to this topic, the question is probably familiar: should you keep holding a stock that has fallen heavily, or sell it and move on? There is no universal answer, because the future quality, valuation, financial strength, and risk of every investment are different. But there is one principle that can be examined objectively: yesterday's purchase price cannot determine today's best decision. Suppose an investor bought a stock because the business appeared attractive. Later, the business deteriorated, the original thesis weakened, and better opportunities appeared elsewhere. Yet the investor refuses to reconsider the position because the stock is already down. The reasoning becomes, I will sell when I get back to my purchase price. That sentence sounds patient. Economically, however, it can hide a dangerous assumption that the market owes the investor a return to the old price. It does not. The market does not know what you paid. Your brokerage statement remembers it. Your emotions remember it. Your brain remembers it. But the future value of an asset depends on what can reasonably be expected from the asset from this point forward, not on the emotional importance of the price at which you entered. This is where the psychology of the sunk cost effect and loss aversion becomes financially important. A realized loss feels psychologically heavier than an unrealized loss, even though the economic reality of the investment does not magically improve because the loss remains on paper. The investor can therefore become trapped by a strange contradiction. The desire to avoid admitting a small mistake creates the possibility of a much larger opportunity cost. And what exactly is opportunity cost? It is the value of the alternative you gave up by keeping your capital somewhere else. Imagine two investments. One is the stock you already own, whose underlying prospects have weakened. The other is a completely different opportunity with stronger fundamentals and a more attractive risk-reward profile. If you keep the first investment solely because you are waiting to recover your purchase price, the real question is no longer, can this stock come back? The more useful question is, if I had cash today, would there still be one of the places I would choose to allocate it? That question removes the emotional weight of the original purchase. It also reveals why averaging down can become psychologically dangerous when it is used as an automatic response to falling prices. A lower price can mean better value when the underlying business remains strong and the valuation has become more attractive. But a lower price can also be a warning that the market is reassessing the economics, competitive position, earnings power, debt burden, or future prospects of the business. Price alone cannot tell you which explanation is correct. So the important distinction is not between a stock that has fallen and one that has risen. It is between a temporary decline in price and a deterioration in the investment thesis. That distinction requires learning. Financial literacy is therefore not simply knowing what a price-to-earnings ratio means or understanding how a market index works. It is developing the ability to separate evidence from attachment. An investor needs to ask what has actually changed, what has not changed, which assumptions were wrong, and what information would invalidate the original thesis. This is also where technology is changing investing. Artificial intelligence can make financial information easier to summarize, compare, and organize, but faster information does not automatically create better judgment. An investor can process thousands of data points and still remain anchored to one emotional number, the price at which they bought. More information cannot compensate for an unwillingness to revise a belief. History repeatedly shows that markets contain cycles of optimism, pessimism, speculation, fear, and recovery, but not every company participates in every recovery. A broad market can eventually reach new highs while individual securities never return to their previous peaks. That is why, it will come back, is not an investment thesis by itself. A thesis requires a reason. What creates the revenue? What protects the margins? What supports future cash generation? What is the balance sheet capable of surviving? What competitive advantage exists? What valuation is being paid for those expectations? What would make the original thesis wrong? These questions transform investing from emotional weighting into analytical evaluation. And there is another hidden cost to holding losers: attention. Capital is not the only scarce resource. Your attention is scarce too. A deeply underwater position can occupy mental space every day. You watch the price, search for explanations, look for positive news, defend the investment in conversations, and repeatedly calculate how much it needs to recover. The financial loss then becomes a psychological subscription that can affect productivity, relationships, learning, and even health. A disciplined financial life therefore protects not only money, but decision-making capacity. This is where Lord Hanuman becomes more than a devotional symbol in the philosophy of investing. Hanuman represents disciplined strength without ego. His power is inseparable from devotion, humility, service, courage, and self-mastery. Applied to investing, that combination suggests a powerful lesson. Strength is not the ability to defend every decision you have made. Strength is the ability to examine your decision honestly and change course when reality demands it. Humility is financially valuable because markets punish certainty without evidence. Courage is financially valuable because recognizing a mistake can be emotionally painful. Discipline is financially valuable because a rational framework must survive both excitement and fear. And devotion, understood as disciplined commitment to a higher purpose, can help separate identity from outcomes. A losing investment does not make you a failure. A profitable investment does not make you wise. The quality of the process matters more than the emotional story attached to one position. The Bhagavad Gita's broader teaching on disciplined action without attachment to immediate results can be understood similarly. You cannot command the market to validate your decision. You can control whether you continue learning, whether you evaluate evidence honestly, and whether your financial behavior remains consistent with reason. So does holding losers always destroy wealth? No. A declining investment can recover. A temporary drawdown can eventually become a profitable investment. Selling is not automatically rational simply because a position is down. The deeper problem is holding a loser for the wrong reason. If the reason is a carefully reassessed thesis, that is one situation. If the reason is, I cannot sell because then the loss becomes real, that is something entirely different. The first is analysis, the second is attachment, and attachment has a price. Ultimately, wealth is not measured only by how many assets you own or how often your portfolio shows green. Wealth is the ability to allocate limited capital toward the best opportunities you can reasonably identify, while remaining capable of admitting uncertainty. Sometimes the most expensive sentence in investing is, I will wait until I get my money back. Because the market does not ask what you paid. It asks what the capital can become now. That is the real engineering of wealth, not protecting yesterday's decision at any cost, but continuously improving today's allocation of capital, attention, knowledge, and risk. And perhaps that is the financial lesson hidden in Hanuman's strength. Do not confuse stubbornness with courage. Courage examines reality. Wisdom accepts uncertainty. Discipline changes when evidence changes. And humility allows you to release an old decision without releasing your faith in your ability to make better decisions tomorrow. A losing position is only one financial event. Allowing that position to control every decision that follows is where the real destruction of wealth can begin. Jai Hanuman.